For most of modern history, wealth was not global. It was local, gated, and controlled by institutions that decided who could participate. Where you were born, which passport you held, and which bank approved you mattered more than how capable or ambitious you were. Opportunity existed, but access did not. In 2026, that quietly changed. Not because governments announced it, and not because billionaires allowed it. It changed because money itself stopped caring about borders. And once that happened, wealth creation followed. For decades, the global financial system worked like a series of locked rooms. Capital flowed freely between major economies, but individuals were trapped inside national walls. Banking access was limited. Investing platforms were restricted. Currency controls slowed everything down. Even when technology advanced, finance stayed stubbornly closed. You could send messages instantly across the world, but moving money remained slow, expensive, and selective. The system was built for institutions, not individuals. By the mid-2000s, pressure began to build. Millions of people were earning online, building businesses digitally, and selling globally. Yet their financial tools were stuck in the past. The mismatch became impossible to ignore. Then 2026 arrived, and the friction finally broke. Payments became faster, cheaper, and borderless. Investing platforms expanded globally. Digital identity, compliance automation, and real-time settlement reduced the need for intermediaries. For the first time, individuals could earn in one country, save in another, invest globally, and move capital without waiting weeks or paying heavy fees. Money began to behave like information. This was not a single invention. It was a convergence. Fintech matured. Infrastructure scaled. Regulation adapted under pressure. And suddenly what used to be impossible became normal. Here is the first major shift people underestimate. Global access did not make everyone rich. It made participation possible. And participation is where wealth begins. When millions of people gain access to savings, investments, and credit at the same time, the financial map changes. Capital spreads out. Opportunity decentralizes. And new markets form where none existed before. In 2026, investing stopped being a privilege tied to geography. Fractional ownership, global platforms, and digital rails allowed individuals to participate in assets that were once unreachable. Stocks, funds, private markets, and digital assets opened up simultaneously. The barrier was no longer location, it was literacy. Those who understood the system moved faster. Those who waited stayed behind. Businesses felt this shift immediately. Entrepreneurs could raise capital from global audiences. Companies could sell internationally from day one. Talent could be paid instantly across borders. Small businesses gained something that used to belong only to large corporations. Global reach. Not someday. Immediately. This is where wealth creation accelerated, revenue diversified, currency risk could be managed, customer bases expanded beyond local demand, businesses became more resilient by default. For individuals, the impact was even deeper. Income stopped being limited by local economies. A designer in one country could earn from clients worldwide. A developer could be paid in stable currencies. A creator could monetize attention globally. This was not about working harder. It was about plugging into larger systems. Another quiet shift happened in savings and protection. Inflation no longer hit everyone the same way. People could hold value outside weak local currencies. They could protect purchasing power instead of watching it erode. That alone changed long-term outcomes. Wealth is not just about earning more, it is about losing less. And global access reduced silent losses. Credit followed the same path. Alternative data, global lenders, and digital underwriting expanded access to loans. Small businesses that would never qualify locally suddenly had options. Capital flowed to ideas, not addresses. Of course, This also created a new divide. Not between rich and poor, but between connected and disconnected. Those who understood global finance multiplied opportunities. Those who ignored it stayed constrained. This is the second major hook. Global access did not equalize outcomes. It amplified behavior. People who saved, invested, and built systems benefited exponentially. Those who consumed without strategy saw little change. The tools were neutral. The results were not. Investors began to notice something else. Capital moved faster and reacted quicker. Arbitrage shrank. Opportunities appeared and disappeared globally in real time. Markets became more efficient, but also more competitive. Information traveled instantly. Money followed it. This forced a shift in thinking. Wealth was no longer about being early in one country. It was about positioning across systems. By late 2026, the idea of a local investor felt outdated. Portfolios became international by default. Risk was spread geographically. Growth was sourced globally. This reduced dependence on any single economy. When one region slowed, another accelerated. Wealth became more resilient. Governments did not fully control this shift. They reacted to it. Regulation followed behavior, not the other way around. Once people experienced speed and access, there was no going back. Here is the uncomfortable truth. Global wealth access did not remove inequality. It exposed it. Knowledge gaps mattered more than income gaps. Those who learned how money moves benefited. Those who waited for permission missed momentum. The biggest winners were not speculators. They were builders. People who created value, structured income, and reinvested globally. This is where the real lesson of 2026 lives. Wealth no longer belonged to the best connected institutions. It belonged to the best positioned individuals. Positioning meant understanding currency risk, understanding platforms, understanding compounding, understanding leverage. The system did not reward luck. It rewarded preparedness. Global wealth access is not a one-time event. It is a permanent shift. The doors did not open temporarily. They were removed. Which means the advantage goes to those who act early, learn continuously, and build long-term strategies. If there is one mistake people make, it is assuming access alone is enough. It is not. Access without direction leads nowhere. The real opportunity of 2026 was not that money went global. It was that individuals finally could. The advice is simple, but not easy. Learn how money flows across borders. Diversify income, not just investments. Protect purchasing power before chasing returns. Build skills that earn globally. Use platforms that scale. Reinvest consistently. Think in systems, not paychecks. Because wealth in the next decade will not be decided by where you live, but by how well you position yourself inside a global financial network. 2026 did not make everyone rich. It made wealth reachable. And in history, that is always the moment when everything changes.